All right. All right, guys. Is this working? Yeah, all right. So I'm gonna take you guys through a bunch of stuff. Normally this is a 100-page slide deck. So I'm gonna try to get you guys through as many of these concepts as quickly as possible. Just to set the stage, my background is I used to be the CM of a software company called Wild Apricot. We sold that to private equity back in 2017, and then they flipped us to a different PE investor in 2018. And going through those two journeys, the PE investors that bought us started asking me for help with their other portfolio companies because we had built that business entirely on marketing and digital and inbound. And most B2B companies that I came across in their portfolios were heavily sales-led. And marketing was one of those untapped levers or a place where they weren't investing enough marketing dollars. And so it became this educational plan, and that's when I started this company where now we work with these leading PE investors as they're buying companies, and we help them figure out how to leverage marketing as an enterprise value creator. And what I mean by enterprise value is what can you eventually sell your business for? If a lot of founders in the room, people that haven't exited or maybe you're planning to exit soon, and when you think about what is the enterprise value of this business from an investor's perspective, when they come and look at your quality of earnings, how fast you're growing, what your profitability is, how efficient you are, what your team looks like. And marketing is a really big part of that I feel like is often overlooked inside these companies. So just as a concept to kind of take you guys through a few of these things, the first place to start is just to think about your business in terms of maturity and how much pipeline you're generating from your marketing efforts. So if we were to take your business and take the amount of dollars being invested into your marketing efforts on the x-axis and how much pipeline you're generating on the y-axis, what we find is that most companies are kind of on the bottom left quadrant here, where they're investing some marketing dollars. Maybe they're doing some trade shows, maybe they're doing some events and some sales enablement work, but for the most part, sales is the revenue driver and the rainmaker inside those organizations. It's very rare to find companies that are in the top right quadrant where they're investing enough, they're being aggressive enough, and they're getting enough of a return on their investment. And very often we actually find companies that are on the bottom right where they're investing a ton of dollars, but they're very inefficient and they don't have enough of the data controls in place to actually do a better job. And on the top left is like a unicorn where you're not spending a lot, but you're getting a ton of return maybe because the market really adapts your product and they're kind of referring more and more customers to you. And the disconnect that I see inside these companies, and just to kind of draw this out, is that if you think about the revenue targets that are set inside companies, most companies set their revenue targets almost like a top-down financial exercise. So either the board or the executive team decides, okay, we want to grow by 2 million or 5 million or 10 million next year. And then there's a quota set or a target set, and then you kind of work towards that. But there's a huge disconnect because inside companies, there isn't enough work being done from a bottom-up standpoint to figure out how much pipeline do we need actually to get to those numbers, and which activities do we need to fund in order to get there. So if I was to kind of just draw out the next step of this, it's like the one thing is that how do we get more MQLs or leads that get us to that number and work our way from the right side of this to the left side to help us eventually get to those targets. And this is one of the reasons why we see most companies underfunded. And meanwhile, they have really great metrics. So if you were to kind of think about your respective companies, if you think about your year-over-year growth rate, your EBITDA margins, your rule of 40, if you think about your net revenue retention, your NPS scores, what the rate from MQL to SQL to close looks like, a lot of companies in this room would have very healthy metrics across the board. Maybe you're growing 25% year over year, 15 to 20% EBITDA margin. That's a healthy business, and I'm sure you guys get pinged by private equity investors all the time asking for a chat to kind of get to know your companies a little bit better because of that. And if you have some of these metrics in a healthy range, then you can make a very strong argument that you should be more aggressive with your marketing investments and your marketing efforts. And when coming back to this concept of like, what is the enterprise value there? So if we were to kind of visualize this, let's say you have a company that has a 12-month CAC payback period, net revenue retention of 110%, and an LTV of 7 years. Every dollar that you invest in year one in your marketing translates into almost $9 in enterprise value as you continue making that investment by year 7. So, and it kind of feeds itself, because the more you invest, the more enterprise value you're generating, the more you have to acquire the customer up front, and the flywheel kind of keeps turning. So it's a bit of an unfortunate thing that we find companies that have marketing budgets that are well below 5% of their revenue, and their marketing generated pipeline is less than 15%. And that's a good baseline to think about it, is what percentage of your pipeline today is coming from marketing efforts. If it's below 15%, odds are your marketing function is quite immature. If it's below 25%, you'd say, yeah, there's some maturity there, but still not enough. Ideally, you want that number to be above 25%, even if you're in enterprise sales, because marketing should be making an impact by targeting your largest accounts and your best fit customers. So with that, and what I want to do is, in this kind of presentation, I'm going to walk you guys through a framework of how we help companies kind of figure out how to build sophistication. And the idea is that the more sophistication you build, the more pipeline and revenue you're going to generate from marketing efforts. So the book that you guys got in your bags, it kind of takes you through this pyramid to sophistication. And everybody wants this outcome of revenue growth. That's one of the first things I hear from a CEO is like, what's your goal in marketing? We want more leads, we want more pipeline, we want more revenue, we want it yesterday, right? And when we meet companies, they just don't have enough of the maturity or the sophistication built out in order to be able to get to that kind of an outcome. And so how you get to that outcome is to build through these underlying layers. So layer 1, these are your foundational elements. This is your TAM and segmentation, it's your product marketing, it's your sales enablement, and it's your go-to-market strategy. Layer 2 is, this is where the actual work happens. These are your programs. This is your demand generation, this is your content, this is your customer marketing. Then layer 3 is the resourcing side. This is your data, your operational infrastructure, your team, and your budget. When we meet companies, and you'll see this in your workbooks, is it's an opportunity, and we can maybe take a slight pause here, is when we meet companies, they're often, if you were to kind of score out of 5, they're good in maybe 3 or 4 of these boxes. Very rarely do you find a company that's a 5 out of 5 in all of these sections. So maybe we take like a quick second here, kind of work through that, and think about where you are on your company's journey on a scale of 1 to 5 in each of these domains, and then I'll dive deeper into what we do to improve our efficiency inside each of these boxes. We give it 60 seconds. Yeah. Yeah, no problem. So I'd say product marketing is more how you message and position your product. Customer marketing would be how you upsell and cross-sell to existing customers to expand their value with you. Yep. Okay, let's continue. So regardless of what number you gave to yourselves, on the next page you'll see a brief scorecard that helps you understand where you are on your sophistication journey. And what I'm going to do now is I'm going to go through each one of these boxes to give you guys a framework to think about it and how do you grow sophistication. So let's start with TAM and segmentation. That's our first place to kind of build value. And this is something that you guys have all probably seen if you've ever built any type of a investor deck or someone's looked at your business. It's TAM, SAM, SOM. And one of the issues with this framework is that it kind of makes it seem like everybody's a potential candidate. Even if you look at some categorizations of potential customers, it looks at many potential verticals, and it overestimates how much revenue is actually in your accessible market or how much you can actually go out and capture. And one of the missing components inside this framework is how likely are you to win that customer that you've identified that's in your TAM. And one of the first places we ask companies to focus is to do a deep customer analysis. And this is a simplified version of this, but to look at and splice your existing customer data to see where it is that you're actually winning your deals. Which verticals, size of accounts, industries, customer segments do you find that you win way more than your competition or other alternatives in the market? And in most markets, one of the biggest competitors is inertia, right? So no decision is probably the most common close loss reason across most companies. So where are you overcoming no decision as an option for your business? And then looking at other metrics like your overall win rates and net revenue retention and your NPS scores. And that should give you a tighter understanding of who exactly to focus on. And that shrinks your TAM, SAM, SOM even more. And we want more of that inside companies. And the reason for that is, as we kind of dive deeper into the data, what we find is that the win rates for your best fit customers are better, your net revenue retention is better, your NPS rates are better. If you look at your medium segments or your worst fit customers, all those numbers come down across the board. And because your best fit customers have higher value, they're actually the ones that you should go and target more. But what ends up happening inside companies, if we were to kind of look at this fourth column and say what percentage of your budget gets distributed across these three segments, in most cases it's a 33%, like one third across these segments. And we don't want this. And if we were to kind of break down the marketing and sales budgets of companies, I would say 80-90%, it looks like this. What we actually want is we want 80% of our budget here, 90% of our budget here, and almost 0% of our budget here. But because companies haven't done this work of understanding which segments they win in, that distribution is fairly equal. And the flip side is also true. The reason is because your best fit customers are actually cheaper to acquire because they refer more people, they stay longer with you, because you have better LTV to CAC ratios, you can spend more upfront to acquire those customers, because their win rates are higher, the CAC payback period comes down. Everything gets better because they are better fits for you. And so we want that budget distribution to reflect our best fit customers. Simultaneously, and this is where we connect to the second part of this, is we want to convert all the work that we've done on this side with the customer analysis, and this is what goes and feeds into our product marketing work. And I see companies get this wrong all the time, is you do your customer analysis work and you understand where you win and where you lose, and then you have to translate that into messaging and positioning in a crowded marketplace. There's like a famous meme out there, which is that software companies are often trying to ask themselves, how do they differentiate themselves in a commoditized marketplace? And when you have one CRM software versus another CRM software, one project management software versus another project management software, it really doesn't matter what the features are. It really matters what the story is, how you're separating yourselves, or do you focus or win or help one customer segment over another, and really dialing in your messaging against those folks. And that's what should be in your messaging on the website, in your sales enablement materials, on the demand gen work that you do. And we often see a disconnect here because the segmentation work is not done right. The work that shows up on the website and all these different materials and the outbound work that's done and the conversation sales reps are having, it's also just kind of this spray and pray approach, even though we know exactly who we're going to win with. And the more of this work that we do, the better our conversion rates get across the funnel, the better our LTV gets, the better everything else improves as well. So the TAM and segmentation work immediately shows up here. And one of the mistakes that I see companies make is they create content in the wrong order. And it relates to this product marketing and TAM and segmentation work. So when a lot of companies that we come into and we're kind of doing this analysis work, they'll have an agency doing SEO work for them or an agency doing paid media work for them. Meanwhile, they're not clear on who they're actually targeting, and they're not clear on where they actually win, and they don't have the right assets built out to land those customers. So there is a specific order you kind of want to work through in order to create as much value for your organization. And SEO would be an example of the last place that you invest your content resources on. A good way to kind of think about this is if you have your product team, you have a product roadmap and you have a prioritization mechanism for your product roadmap. And if somebody on the team wants to add an item to the product roadmap, it gets added to the Kanban board, there's a prioritization mechanism, and then they kind of figure out where they want to focus their resources first. Content is very similar because it has needs across the business, but in order to build a great go-to-market engine, these priorities of product marketing and sales enablement and the nurture stuff that needs to be built out for the essential customers that you're targeting needs to be built out first before you get to more of the top of funnel stuff and the fun thought leadership stuff that everybody kind of talks about. And the more the messaging and positioning work that you do up front and the more the customer analysis work you do up front, the easier this will be to do and the more effective content ends up being. And then the final thing I want to make as a point on this piece is the budget that we're allocating to our best fit customers, how it translates to positioning and messaging is the best type of product marketing follows a simple framework. You have a pain point, you diagnose the pain point, you offer an antidote. I'm sure people here have seen different frameworks like this. What I see most companies do is they kind of just talk about their feature set and the problems that they're solving for their particular customer. But what you actually want to do is you want to have a preeminent position in the marketplace for whatever your category of software is. So if you are, for example, selling a tool that helps professional services firms do better, well, you definitely probably have some time tracking features. But if you talk about time tracking, you're not going to win them. Instead, if you talk about how to run a world-class professional services organization that makes sure that your effective hourly rate is high, that enables you to figure out your operations at a better or more efficient level, then you're kind of talking about all these other pain points that that person is facing. So if we were to kind of layer this out and list out all the hundreds of pain points that your customers have, and there might be 30% of them that your software actually addresses, but then the other 70% that they are still struggling with, the more you create content for that exact ICP and you help them with that, the more preeminent your position becomes and the more you stand out in a crowded marketplace with commoditized features. Because the feature really doesn't matter. HubSpot versus Salesforce versus Pardot, all these other tools really doesn't matter. It really matters who really understands the customer and is able to kind of talk to those pain points. And then on the sales enablement piece, I kept it simple here just to help you guys understand, but the more of this work that you do on the left, the more it should show up in all the materials you use. And I even listed the website here as sales enablement content, because that is the first role of the website, is actually sales enablement. It is not technical SEO. It's not to drive top line traffic through organic SEO and listings. It's to actually communicate who you're for, why you win, what's the message, what's the benefit that you're providing to that customer. And then it also needs to show up in all the other places that your sales team is using to communicate with the customer. And if you have more of a self-serve product, then on all the other self-serve resources and sections that the customer will interact with your company. So that could be on your help site, it could be on YouTube videos or tutorials, it could be in product, in your in-product onboarding and things like that as well. Okay, next. I want to talk about the go-to-market strategy piece. Coming back to the pyramid just to kind of simplify this. So where we are, we just did these first three. And by the way, at the end of this, I will share a QR code for the deck that has way more detail on all these slides that you guys can get access to, but just to kind of walk through the frameworks. On the go-to-market strategy, this is the first framework that I kind of want to walk through. So there's a direct correlation between your average deal size and your total addressable market. The larger your average deal size, the smaller your total addressable market. Everybody kind of intuitively understands this. But your go-to-market must correspond with that. So if your average deal sizes are 200,000 plus, you have to take a one-to-one approach to your go-to-market efforts. And I can't tell you how many times I've met enterprise B2B companies that are still doing more inbound or still kind of one-to-few marketing in order to get those large accounts. On the flip side, if you have a transactional product that's $5,000 to $10,000, you should be all in on inbound, go one-to-many, and have as much volume coming through the door to sift through with your SDR teams and your inside sales team. A good example of this is like if you have a low ACV, high TAM type of business or product, the channels that might be most relevant to you would be paid search, paid social, SEO, more nurture, inbound webinars, those kinds of channels. And if you're more high ACV, limited TAM, then it's going to be things like sales enablement, events, it's customer marketing, account-based marketing, and very tailored channels and programs that need to be running. So it's important to kind of figure out which ones are applicable to you. And you guys will see some version of this matrix in your workbooks, which is just to figure out for your business, based on your average deal sizes, which channels are more relevant to you than others. And I constantly see marketing budgets misallocated by companies, even though they should not be investing in a particular channel given the types of deals that they're investing in. So if, for example, you are targeting the largest 600 CPG companies in the country, then you probably should not be investing in more SEO channels. You should be focused on relationships and getting in front of those accounts on a one-to-one basis. On the flip side, if you are more of like a $2,000 project management software, you should not be doing any type of ABM. It should purely be volume and broad-based marketing across all the different channels where you can kind of interact with customers. So this is more of an exercise for yourself to think about, which is which channels are most applicable and relevant to you. And the thing that I'll keep coming back to with you guys is marketing budget allocation. This is, I would say, if we were to categorize marketing mistakes, one of the biggest mistakes, I'd say there's 4 types of mistakes. One is the wrong strategy, 2 is the wrong focus areas, 3 is the wrong team, and 4 is the wrong budget. It could be too much, too little, and budget is like the X factor, because if you have the wrong budget, none of this actually works, and allocation is where companies get a lot of things wrong and a lot of efficiency is overlooked. So bringing that question back, and if you have a marketing leader, that should be the question, is what is the right size budget for our team in order to get to the targets that we want to get to? And what is the right size pipeline we should be generating for the amount of budget that we're investing? So even if you're, let's say, spending $2 million on marketing, is 1.5 million pipeline and revenue good or bad? It's kind of hard to tell if you don't have a clear scientific understanding of what that should flow like across all the places that you're investing your marketing dollars. Okay, let's keep going. So now the next question becomes, if we have our strategy intact, how do we actually scale demand gen in particular? And I'll bring you guys to this framework here. So it's 4 steps, and it's super simple, and every company can do this if they look at the data in the right way. But I'd say step 1 is cut your inefficient spend. Step 2, reallocate to channels that are working well. Step 3, maximize your efficient channels. And step 4, scale the channels that are working really well, or new channels that you've never invested in. What we find, if we just take companies through steps 1 to 3, and we do this all the time, we find at least 20% inefficiency. In some cases, we found like 70 to 80% inefficiency. As an example, there was a public company that an investor took private, like $200 million business. We found $25 million in waste in their marketing spend. And they lost no revenue by cutting that spend, about 600K. But that's well worth the trade. So how we do this is by looking at the data. And I kind of have the line from revenue ops also going to this, because rev ops and demand gen in this way are closely intertwined. What you want to do is you want to be able to, on a global level, track your conversion rates throughout the funnel. So you want to know from lead to MQL to SAL to SQL to close one, what are our conversion rates globally? And working your way backwards to figure out how many demos does it take to close one deal. At some level, you guys intuitively probably know this, like 1 out of 5 demos becomes an SQL, 1 out of 3 SQLs becomes a closed one deal for you. If your average deal size is $100,000, that means per SQL, you could spend up to $33,000 and still break even in the first year. And if you did that work backwards to the lead level, you might find out that you can spend $2,000 per lead. I find that a lot of companies don't intuitively understand the lead number. They might know on the SQL level, but they don't know it on the lead level. And this one is a really important data point because it helps us figure out how much can we spend upfront per channel to acquire a lead that is a good fit for what we're selling. And if I was to kind of bring this to life a little bit more as an example, if we were to look at it on a channel level, you're going to find that the numbers are different on a channel by channel basis. I kept it simple here. I just gave two channels here, but you should be doing this for every single channel that you're investing in. And what you're going to find is some channels are more efficient than others, yet you might be spending more or less on the channels that are less efficient. So we've all the time come into companies that, let's say, are more sales-led, and the biggest bucket of marketing spend is events. And they're spending $800,000 on events because when a SaaS company starts, it's usually founder-led sales. I think somebody said it earlier that they're out of founder-led sales. So that's the number one channel usually. Events ends up becoming the second channel. And as the company scales, the founder kind of replaces themselves with SDRs and AEs, and the company can theoretically grow to 100 million plus. Like I've met $100 million companies that have less than 10 marketers on their team, which is crazy. There should be some proportionality to that, but the reason is that if you have great product market fit and you have something a market wants, you can scale it with SDRs and AEs. So what you want is you want to look at every single channel, and you want to look at your conversion rates, how much you're investing and how much pipeline is coming out of every single channel, and then it'll give you signals on which ones are more efficient than others. And the ones that are less efficient, you should scale down. So in this case, we're saying that the events channel is much more inefficient than the paid media channel. So we could scale this down and we could scale up our paid media spend. If you were to do this on a global level across all channels, you're gonna find that 3 or 4 of your channels are really the winners, and the rest of your spend is actually going to things that doesn't actually work as well. You can take this a step further, because it could be that events are actually really great for you because there are 3 events that you go to that are the main trade shows or events for a particular industry. and the other 10 or 15 that you go to are not as profitable or don't bring in as many leads. So if we do it at a campaign level where we're looking at event by event, it might be that those 3 events are some of the most profitable things that we invest in on an annual basis. But because those 3 are so profitable, we added on these other 10 events that we go to now that are less profitable. So now this is spend that we could cut while retaining the good part about this channel, and then looking at where we could take this spend in other channels and reallocate that budget. One of the main complaints I get from marketers is that they wish that they had more budget for marketing, but because they haven't done this exercise, they don't realize that there's budget sitting in their current spend that they just haven't figured out how to get more out of. So that would be a huge one to just kind of figure out, and it's the more you go campaign by campaign, you're gonna find a ton of insights. And then the third step, coming back here, is to maximize channels that are working really well. So let's continue with our example here, where we're spending about $1.5 million, we're generating about 1.8 million in revenue, and the CAC is about 9 months. The next question would be, well, how much more room is there to spend in this channel? And this is another question that I see companies not asking themselves, because the amount of spend that you can potentially invest in a particular channel might be 2x, 3x, 5x, or even 10x. There was a market leader in the customer experience space that I worked with in Europe a couple of years ago, and they were spending about $50,000 a month on paid media. And when we came and did the scale up potential analysis, it was that they could spend $500,000 a month because of how big the market was and how much potential there was to spend, but nobody had ever done that work, and they were crushing it on their paid media, but nobody had kind of done that analysis. So my ask would be that if things are actually going well for you, you have to kind of double down on those areas instead of kind of going with the shiny object syndrome of this next new channel that I want to try, or I want to now launch a podcast, or I want to start a YouTube channel, or whatever it is. Until you've done this work and maximized your current channels that are doing really well for you, putting more good money into other channels is not as profitable and not the best thing to do. And then finally,
Shiv, can you answer the question really quickly on when you are working with individual companies, are you changing your attribution model? To do this, you have to pick somehow are we attributing what to each channel?
Yeah.
Like, events probably makes paid more efficient if we go to events to zero. So are you changing your attribution model based on the company you're evaluating, or do you have one that you go to?
That's a great question. For me, the attribution model matters less. It's actually the most common question I get about this stuff, because some channels are going to give you good data from a first touch standpoint. Some channels are going to give you good data from a last touch standpoint, and some require multi-touch, and then some are hard to measure. Like an example of something that's hard to measure is like webinars. You came in through an event that I met you at, your last click is coming from branded search, but then you still came to my webinar and read a blog post. Like, how much credit do I really give to that webinar? So my advice on that would be, in each channel, use the attribution model that gives it the most credit. I'm okay with webinars saying that we had 100 attendees, and out of those 100 attendees, 10 became SQLs for us. That means that activity is creating an environment for us to be able to sell. So we would never stop that activity as long as the numbers are in a good range. So I would say that's where it kind of becomes more of an art than a science, to approach it in a way that where you're kind of using your decision making and judgment to make that call. But triangulate the truth with as many attribution models as you can. And what we've seen inside companies is, as a baseline, they're not doing any of this. So I would say even if you could choose one of them, you're better off than having nothing going on the analysis side. And then as you start layering on one over the other, then you start to get to deeper insights. Yes, so next step. So scaling new channels. So this, I would say, is the net new opportunity. And the reason this matters is, especially if, let's say you have never done that much investment in marketing, or let's say you're currently spending less than $500,000 or $1 million on marketing. And we meet a lot of companies like this that are sub 10 million. They're like, hey, a lot of the stuff that you're talking about, we don't have anything to analyze. So where do we start? And in general, if you've never, or even if you're trying to figure out where to scale new, or if you've never invested that much, the best way to kind of think about this is as swim lanes. So customers across the buyer journey are trying to figure out solutions to different pain points. And what I see companies do, if we were to label this simply, right? Unaware, awareness stage, knowledge, consideration, you label it differently: solution aware, problem aware, et cetera. But you want to start with people who are most ready to buy and in market today, and work your way backwards to people who are unaware. there's always going to be a segment of customers that is ready to buy today that you have not maximized for. And I see a lot of companies investing marketing resources on the left side of this before they have maximized here. And so if you think about every single channel, whether it's paid media, whether it's events, whether it's account-based marketing, let's use account-based marketing as an example. When we talk about ABM, a lot of companies think it's about targeting net new customers. Yes, that's true, but if you did white space analysis on your existing customer base, you might find that 10 accounts, if you cross-sold them enough revenue, have another 10 million in potential revenue just sitting there for you. So our ABM effort, the best use of those resources might be to expand those existing customer accounts so that we increase their LTV with our business, and that's going to be recurring and we already have a relationship with them. Instead of going to net new and getting a CRM software that specializes in ABM platforms or software and things like that costs over 100 grand. Similarly, for every single channel, work your way backwards. And until you're done maximizing on the consideration side, don't move to the next stage. And we see a lot of marketers burn political capital here because they will launch campaigns on the far side, sales cycles take too long, and before you know it, the VP of marketing has been fired. On average, a CMO or VP of marketing's tenure is like less than 18 months. Same with a CRO. So nobody's actually delivering enough results to earn the political capital to work through this. And so the more you deliver, the more you can show progress at a board meeting or to the executive committee, and then start to get more budget for the things that we want to do. And then the same thing, and I'm connecting it to content here, is similar to how you would move backwards on a particular channel, your content needs to support that as well. And we talked about the order of content earlier. These frameworks are connected to that as well. I'm big on order of operations, working backwards, like just process-driven things, because that's how we simplify all the work that has to be done here. So from a content perspective, if you are, for example, launching late funnel ads to people who are in your ICP, well, you better make sure you have enough sales enablement materials or conversion materials for those prospects. That's kind of intuitive to understand, but when we audit companies, and we often do like a content inventory, and we look at where the biggest gaps, sales enablement is one of the most obvious areas where there's gaps. There aren't enough case studies. When they look at their TAM or their segments where they win, they don't have verticalized references for those accounts. They don't have enough battle cards against the competitors where they're most commonly coming up against. So doing a full audit and figuring out at which stage do we not have content or where do we have the biggest gaps, and that helps us prioritize where we divert those content resources. Again, it's that order of operations, right? So product marketing, then sales enablement, then nurture, then we get to more of the top of funnel stuff or the thought leadership content. And also connected with this is worth mentioning is just the strategic levers. I've met clients. We had a client once in the data analytics space, decent business. It was about 7 million in revenue. It was profitable. I put it in quotation marks, but then. And it looked like it would be a good account for us, and we started working with them. And then when we looked at their internal data, it turned out that their net revenue retention was below 90%. But he had come to us wanting to get more pipeline and demand gen, and immediately became obvious that actually the best demand gen work you could do is retain your existing customers. And so depending on where you are and understanding what are the biggest strategic levers, and when we talk about private equity, we're doing a session tomorrow with Diamond, and we're going to talk about what PE investors look for when they're acquiring your business. One of the first things they do is quality of earnings. Do you have repeatable revenue? Is it recurring? And so that when they buy your business, is it predictable enough in the future that it's going to continue growing at a certain pace? And one of the things that I think founders, the way they leave money on the table is there are obvious things that investor will do even if the acquisition is successful in the first 100 days. The more of those items that you do up front, the higher your valuation will go. So one of the first things that they'll probably do is look at your pricing. And pricing is one of those areas where it's completely underserved, like you kind of leave a lot of expansion revenue on the table. So going through a full pricing analysis and different segments and how you can find expansion there is important. Same thing on seat expansion, same thing on upsell and cross-sell, especially if it sits inside your existing accounts. And then the last one is M&A, but M&A requires more capital to be able to execute on. The reason this is important for marketing is I see a lot of marketing teams disconnected from this work. And the CEO's expectation on marketing is just get me more leads. But in order to effectively do all of this work, you need an exceptional marketing function. So on the retention side, the best way marketing can help there is, for example, improving the onboarding that happens when you land a customer. It could be improving targeting. If you are targeting the wrong customers, your retention is going to be worse. So if they do a better job of targeting the right fit customers, your retention is going to improve. On pricing, similarly, right? Every time we do a pricing increase, we have to communicate in the right way. We have to have the right feature set. We have to work closely with product. On upsell, cross-sell, seat expansion is working closely with sales, right? On M&A, it might be integration. So all of this work has to be connected to this demand gen work that we did at the front end of this, and in terms of working backwards and focusing on existing customers is, I would say, the next quadrant over that's not on this slide, but really thinking about that and prioritizing that against everything else. And then finally, I'll just talk about resourcing, and that gives us a good amount of time for Q&A, is on the team. So this is a very, I'd say, the most atomic unit of a team. One way or another, your organization on the marketing side needs to look like this, where you have one marketing leader, VP marketing, CMO, whatever you want to call it. You have a functional lead for demand gen, functional lead for content, functional lead for corporate marketing, one for product marketing, and one for ops. Inside most companies that we see that are sub 10 million, this is all one person. And that's a miss, because there's no way one person can do all the work that I just described above. So we see a lot of understaffed organizations. And then if you are way beyond that, let's say you're 50 million or $100 million business, this just scales. So it scales by having regional teams, like we've seen public companies with a different team for APAC or LATAM or EMEA or whatever. You can do it that way. You can do it by business unit. If we have business unit 1, 2, you can have shared services where paid media is a shared service for all different business units. But at an atomic level, regardless of what size you are, it should look like this. And what you want to do on the team side is, based on all the work that we've described above, you should have a prioritized roadmap of where you want to invest your marketing dollars or where the biggest opportunities are. And the question becomes, do you have the people to actually be able to execute on that? I'd say one of the biggest gaps that we see is CEOs don't have the right CMO to be able to do all this work. It's kind of like a director of marketing that's trying to level into what a CMO truly would do, which is a lot of this work, but they're not able to kind of close that gap. And so a lot of this work is not getting done. So I would say getting that seat right is a huge strategic priority to do a lot of this work. So that's number one. And then for the other functions, making sure that CMO has the right functional heads inside each of these seats. And if there are gaps inside the organization. So for example, let's use demand gen. Let's say we're a 250,000 ACV product, limited TAM, and we say, okay, ABM is a huge priority, but the only demand gen person that you have is somebody that specializes in inbound. You have the wrong person in the wrong seat. That person will not be able to scale the kind of ABM campaigns that you need to run. So figuring out, what is my go-to-market strategy, and does my team correspond with that strategy? You might need a completely different set of marketers to actually roll out the strategy that you've kind of identified for your company. And so I think that mismatch is a huge missed opportunity inside companies, because the right people are not in the right seats. So thinking about, where are my biggest gaps inside each of these functions? Which seats do I need to replace? Where do I need to add headcount? Where do I need to subtract headcount? And do I need to potentially part ways with my CMO if the timing for that is now? And then finally, I'll just round this out here, is to say you want to adjust your budget and your headcount accordingly. So this is oversimplified. We can get very detailed with this, but you start with what was your old headcount? What's your headcount spend? What's your program spend? How much pipeline are you generating? How much revenue are you generating? And you want to look at, what should that look like? And we see these kinds of transformations all the time, where companies are either investing more in headcount or more in program spend, but they're seeing 2x, 3x, 5x the pipeline. In other cases, we've seen the opposite, where we've taken a company with 150 marketers and brought it down to 75 marketers and cut spend and cut program spend because there was a ton of inefficiency inside their budget. So depending on your scenario, the transformation will look different, but where you want to get to is, again, that the question is, what is the right size budget and what is the right size team for the size of business that we are? And the answer will be different for each and every one of you. So if you're a $30 million business, your marketing budget should roughly be somewhere between 2.5 to 3.5 million. I can roughly estimate that for you. But then how much pipeline should you generate depends on a lot of the specifics that we've talked about. So you kind of want to think about what that looks like for you. But the goal of all this is to be scientific with our marketing efforts, right? So as much data as we can bring to the table, to be proactive, to make these adjustments so that we can come and make the business cases to scale things up and have marketing be a real contributor to the overall revenue for an organization. So I will stop there and let's do some Q&A and then we can go from there.